Today, we're diving into a controversial topic that might raise some people's eyebrows. We're going to discuss why you might want to stop saving money in 2025. Yes, you heard that right. Now, before you jump to conclusions, let's unpack this together. Grab a snack and let's get started. To kick things off, let's first understand the traditional approach to saving money. For generations, people have been advised to save diligently for future needs. Phrases like, save for a rainy day, and you should have several months' worth of expenses set aside have been ingrained in our financial education. It all sounds reasonable on the surface, but let's dig a little deeper. The reality we face today reveals some flaws in this age-old advice. Consider the issue of low interest rates. As of recent trends, many savings accounts hardly offer any significant interest, sometimes even less than the inflation rate. What does this mean? Simply put, if you keep your money in a standard savings account, it could lose its purchasing power over time. Your hard-earned dollars, which you intended to save, may be worth less in the future than they are today. Now let's talk about how saving might not align with your financial goals. Have you ever taken a moment to evaluate what you truly want out of life? Travel, starting a business, investing in education? These aspirations often require cash flow and risk-taking, not just saving. Traditional saving can sometimes feel like a stagnation of potential. Money that could be utilized for growth, experiences, and opportunities just sitting in a bank. And one cannot ignore the changing economic landscape. With the rise of digital currencies, growing investment markets, and alternative investment opportunities, the financial world is evolving quicker than ever. While saving may have been the safest option a few decades ago, today's environment suggests that diversifying your approach can yield better financial stability and growth. Moreover, let's touch on the psychological aspect of saving. Many people associate saving with security, but it can also breed anxiety. When you focus solely on saving, you might develop a scarcity mindset, leading you to fear spending money or taking necessary risks. It's about finding the right balance to ensure your financial peace of mind. So as we move forward, it's vital to reconsider the traditional saving mindset. In 2025, let's not just focus on saving for the sake of saving. Let's think strategically about how we can put our money to work. Understand that while saving is essential to some degree, other avenues can help you achieve financial freedom and growth much faster. Now that we've unpacked the limitations of traditional saving, let's shift our focus to the world of investing, a realm that can open up a wealth of possibilities in financial growth, especially as we step into 2025. First and foremost, let's discuss the stock market. Historically, investing in the stock market has produced average annual returns of about 7% to 10%. This might seem like a small number, but when you consider the power of compound interest, it tells a different story altogether. For example, if you invest just $1,000 today and let it grow at a 7% annual return, in 30 years, that money could grow to over $7,600, all without adding a single extra dollar. This concept of compound growth reinforces the idea that keeping your money idle in a savings account could result in missed opportunities for significant returns. Next, let's explore real estate investment. The market for real estate continues to evolve, with opportunities for both property ownership and rental income. Buying a rental property isn't just about having a place to live. It's about acquiring an asset that generates income. Imagine owning a property that not only appreciates over time, but also provides you with monthly cash flow. With the right investment, real estate can be a game changer, driving your financial journey in the right direction. Now, we can't ignore the rise of alternative investments that didn't exist a short while ago. Cryptocurrency has captured the attention of countless investors around the globe. While it comes with its own set of risks, some individuals have seen extraordinary returns by investing wisely in digital currencies. But remember, education is key. Diving into these new markets requires research and an understanding of the specific assets you're dealing with. Another point to consider is the difference between active and passive investing. With the growing popularity of index funds and ETFs, it's easier than ever to invest passively. By investing in a diversified fund that tracks a specific market index, you can achieve similar benefits to stock picking without the time or stress involved in managing individual investments. Let's also explore the concept of entrepreneurship. Instead of simply saving money, Think about using that capital to start your own business or side hustle. This path may involve risks, but the potential payoff could be much greater than any interest you'd earn from a savings account. Your skills, creativity, and time can lead to a venture that not only fulfills your passions, but also creates a new stream of income. Lastly, keep in mind the importance of investing in yourself. Consider taking courses, attending workshops, or acquiring new skills that can grow your income potential. Investing in your financial literacy or enhancing your professional abilities could yield higher returns than simply letting your savings grow at a paltry interest rate. As we navigate through 2025, the emphasis on investing rather than saving becomes crucial. The goal is to reframe your perspective on money. See it not just as something to save, but as a tool to grow, create, and live more fully. Investing is a key part of a progressive financial strategy, allowing you to take control of your future and potentially achieve the lifestyle you've always dreamed of. As we delve deeper into our discussion on why we should reconsider our saving habits in 2025, we must emphasize the critical role of financial literacy. In a rapidly changing economic landscape, understanding how money works has never been more crucial. Financial literacy is not just about budgeting, it's about knowing how to make informed decisions that can significantly impact your financial well-being. First, let's break down the difference between various investment vehicles, beginning with stocks and bonds. Stocks represent ownership in a company, which means that as the company grows and profits, so does your investment. On the other hand, bonds are essentially loans that you give to companies or governments, which pay you back with interest. Understanding these differences is essential when constructing a diversified investment portfolio. Diversification helps mitigate risk, as it ensures that if one investment underperforms, the others may still provide stability. But financial literacy goes beyond just stocks and bonds. We live in a time where cryptocurrencies have emerged as a new asset class. Bitcoin, Ethereum, and various altcoins have gained massive popularity, but they are also highly volatile and speculative. Educating yourself on the fundamentals of blockchain technology and the intricacies of different cryptocurrencies can help you navigate this complex and often confusing market. It's about knowing the potential rewards as well as the risks involved. Moving on to retirement planning, understanding your options within retirement accounts like IRAs, 401ks, and Roth IRAs is vital. Each of these accounts offers unique benefits and tax implications. For instance, contributions to a 401k may be tax-deferred, allowing you to increase your savings without immediate tax burdens, while Roth IRAs allow for tax-free growth and withdrawals in retirement. Being able to maximize these accounts not only helps in building a retirement nest egg, but also minimizes the tax impact, potentially saving you thousands of dollars over your lifetime. Moreover, financial literacy helps you understand concepts such as compound interest, which is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. This principle can work in your favor when you're investing. It means the earlier you start investing, the more your money can grow over time, thanks to the power of compounding. Conversely, understanding how compound interest can affect loans and credit cards is equally important. Knowing how quickly debt can accumulate can help you make better borrowing decisions. Let's also touch on risk management. Understanding your risk tolerance is a crucial part of investing. Different investment strategies entail varying levels of risk, and assessing your capacity to handle fluctuations in your investment value is imperative. Financial literacy enables you to create a strategy that aligns with your financial goals and your comfort level. With this understanding, you can avoid emotional decisions during market turbulence and stay focused on the long-term picture. Additionally, there's the importance of setting financial goals. Defined goals can guide your savings and investments, whether it's buying a home, funding your children's education, or planning for retirement. Having clear objectives provides motivation and direction. Each goal might require a different strategy, and knowing how to allocate your resources effectively to meet those goals can drastically improve your financial outcomes. As we embrace 2025, the need for financial literacy becomes more pressing. It empowers individuals to take charge of their financial futures, enabling them to make confident decisions rather than relying solely on traditional advice or hearsay. The better educated you are about finances, the more effectively you can navigate opportunities and challenges that come your way. By prioritizing financial education, you not only gain insights into growing your wealth, but also cultivate a mindset oriented toward financial independence. The ability to analyze, evaluate, and act with confidence on your financial matters can lead to a prosperous and fulfilling life. So let's lay the groundwork for a future built not solely on saving, but on wise investment and financial growth. Now that we've explored the nuts and bolts of financial literacy and investing, it's time to dive into a crucial yet often overlooked aspect of our financial journey: the psychological perspectives on saving and spending. The way we think about money can profoundly influence our financial behavior and overall well-being. To start, let's talk about the concept of the scarcity mindset versus an abundance mindset. A scarcity mindset is often rooted in the belief that there is never enough money to go around. It fosters fear, anxiety, and a reluctance to spend or invest, leading to hoarding behaviors and excessive saving. While planning for the future is important, if we become overly fixated on saving, we can miss out on valuable opportunities to enjoy life and grow our wealth. Conversely, an abundance mindset encourages a healthier relationship with money. This perspective emphasizes the potential for opportunities and recognizes that financial growth is possible. When you adopt an abundance mindset, you're more likely to view spending as an investment in your future rather than a threat to your savings. You begin to see expenses, be it for education, experiences, or investments, as stepping stones towards greater returns and a fulfilling life. Next, we should consider the role of emotions in our financial decisions. Many people make money decisions based not solely on logic, but also their emotional state. When you feel stressed or anxious about finances, you might resort to overly conservative behaviors like stashing away funds without a clear plan or avoiding investments entirely. Conversely, during times of excitement, you might make impulsive decisions, like investing in flashy stocks without proper research or planning your retirement around a luxury purchase. Understanding the impact of emotions on your financial choices allows you to create a more balanced approach. It's crucial to develop mindfulness techniques when dealing with money. This could mean taking a step back and assessing your motivations behind saving or spending. Are you saving out of fear or for a genuine goal? Are you spending to fill an emotional gap? By being aware of these triggers, you can make more deliberate financial decisions. Let's also discuss goal setting and its psychological benefits. Setting specific, measurable, attainable, relevant, and time-bound smart financial goals can significantly boost your financial morale. These goals become your roadmap and give you a sense of purpose. Whether it's saving for a vacation, investing in a business, or building a retirement fund, having clear objectives helps reduce anxiety around finances. You can see a pathway forward instead of being consumed by uncertainties. Furthermore, envisioning successful outcomes can be a powerful motivator. Visualization techniques, where you see yourself achieving your financial goals, can reinforce positive behaviors and keep you focused on your plans. It encourages a positive association with investing, creating excitement rather than fear. Another critical element is the concept of community and support. Engaging with like-minded individuals can vastly improve your financial mindset. Conversations about investments, saving strategies, and financial literacy can help normalize discussions around money, allowing you to share your insights and learn from others' experiences. Being part of a community that prioritizes financial growth fosters accountability and motivation, encouraging you to make informed financial moves. Finally, let's touch on the connection between financial health and overall well-being. Studies have shown that financial stress can impact mental and physical health. Your financial situation touches every aspect of your life, influencing your relationships, job satisfaction, and even your happiness. By adopting a proactive approach to your finances, one that balances saving, investing, and enjoying life, you can mitigate stress and enhance your overall quality of life. As we wrap up our discussion on why we might want to think about stopping saving money in 2025, it's crucial to understand the importance of creating a balanced approach to managing your finances. Striking the right balance between saving, investing, and spending can be the cornerstone of financial success and personal fulfillment. First and foremost, let's emphasize the necessity of maintaining a solid emergency fund. This fund acts as your financial safety net, and should ideally cover 3 to 6 months' worth of living expenses. Having this cushion allows you to navigate unexpected situations like job loss, medical emergencies, or urgent home repairs without disrupting your long-term financial strategies. It provides peace of mind and stability, freeing you up to make more strategic investment decisions without the weight of financial anxiety. Once your emergency fund is in place, it's time to reallocate your focus towards investing. As we've discussed earlier, the stock market offers excellent long-term growth potential compared to traditional savings accounts. It's vital to consider your investment strategy, which could include a mix of stocks, bonds, real estate, and other alternative assets. Diversification not only helps in spreading risk, but also maximizes the potential for returns in various market conditions. When setting up your investment strategy, consider aligning your investments with your values and interests. For example, if you're passionate about sustainability, you might explore investments in green technologies or environmentally responsible companies. This alignment not only promotes financial growth, but also enhances your personal satisfaction and sense of purpose in your financial journey. Another critical component is automating your finances. Setting up automatic contributions to your investment accounts or retirement funds can help you stay disciplined and consistent. Automation removes the emotional decision-making process from saving and investing, as funds are transferred without requiring proactive thought. This strategy encourages building wealth on autopilot, making it easier to grow your portfolio over time without the stress of needing to remember to contribute manually. In addition to automation, consider adopting a mindful spending strategy. It's essential to differentiate between needs and wants, focusing your spending on experiences and purchases that truly enhance your life. This approach aligns with the idea that money should facilitate life experiences, not just accumulate. By following a mindful spending strategy, you can enjoy what you have while ensuring you're also putting money toward your financial future. Moreover, staying adaptable is vital in our ever-changing economic landscape. Regularly review and adjust your financial goals and strategies to fit dynamic circumstances. Changes in income, expenses, or personal priorities can significantly impact your financial outlook. Making it a habit to revisit your goals ensures that you remain aligned with your broader life objectives while allowing you to pivot as needed. Let's not forget the importance of continuous learning and self-improvement in managing your finances. This could involve reading books, attending workshops, or even engaging in online courses related to financial management and investing. The more informed you are, the better equipped you'll be to make savvy financial decisions. Remember, knowledge is power in the world of finance, and personal growth can lead to substantial rewards. Finally, establish a support network of friends, family, or financial advisors who understand your financial aspirations and can provide encouragement and accountability. Sharing your goals and progress with others can motivate you to stay on track. Alternatively, engaging in discussions about finance can lead to new insights and strategies that you may not have considered before. In conclusion, as we approach 2025, it's not just about stopping the act of saving, but about reimagining how we manage our finances in a more intentional, informed, and balanced manner. By maintaining an emergency fund, reallocating to investments, automating finances, practicing mindful spending, remaining adaptable, committing to continuous learning, and building a supportive network, we can create a solid foundation for financial health and well-being. So let's challenge the notion of saving for the sake of saving. Instead, let's focus on making our money work for us, allowing us to invest in our dreams, goals, and experiences, ultimately leading to a more enriching life. Here's to a prosperous and fulfilling financial future in 2025 and beyond. Thank you for joining us today, and remember, your financial future is in your hands. Let's make 2025 a year of financial growth, opportunity, and abundance. Until next time, take care and keep investing in yourself.